Hey everybody, Jason Wilson with Ursula and Associates. Today we're going to talk about forbearances. Stay tuned. Welcome back. So you may have seen in the news the term forbearance, and simply put, layman's terms, that just simply means if you're in a situation where you're one of the unfortunate Americans who have been put on unemployment and you can't afford to pay your mortgage, you can ask for a forbearance which would allow you 3 to 6 months, sometimes more, where you don't have to make the payments. The question is, what happens with those payments? Do you ever make them? Do they go to the back of the loan? If you have a 3-month forbearance, on month 4, do you have to pay 4 months all at the same time? These are all questions that are surfacing as a result of how the banks are communicating. What we can see is that there are multiple options in a lot of cases, and so we're going to try to clarify what forbearances look like, what's the next step after a forbearance, and how does this work. First thing, let's talk about what forbearances are designed to do. They're designed to create temporary relief for a temporary situation of interruption in income. So, if you've lost a job and you need a couple months off, that's what a forbearance is there for. It assumes that you will get gainful employment and be able to start making payments again and make up the back payments. That's the part where people are going to get caught in this. Now, what we don't know is what all the options look like. I think they're breaking that down as we speak. In some cases, it'll be more favorable, in other cases, not so much. So let's tell you what the worst case scenario can be and what the best case is. Worst case scenario. You get a forbearance for 6 months. On month 7, you have to pay months 1 through 6 and month 7. Most people in a situation like that aren't going to be able to do that. Best case scenario, they'll take those 6 months, they'll put them at the end of a loan, sometimes with interest, sometimes without. It'll simply sit there as a second loan that will be paid off when you pay off the loan. That's kind of the best case scenario. So you do a forbearance, you go 6 months out payments, month 7, you resume your normal payments, you carry out the loan. When it comes time to refinance or sell the house, they'll take your normal payoff plus those 6 months you didn't pay as a junior lien, and they'll pay all of that off at that time. That's your best case scenario. So why are we talking about this? Well, because depending on how the bank chooses to reclaim that money, what options they give you, anywhere from the best case scenario to the worst case scenario, people find themselves playing catch up no matter what it is. So in 2008, we saw forbearances become the first barrier to stopping and preventing foreclosure. What came after that was loan modifications. If you participated or heard anything about loan modifications back then, most loan modifications would go through a process where it would take them 90 days to decide whether they were going to grant you a loan modification. Then if you were denied that modification, what would happen is they would be like, well, you're so far behind, we're now going to foreclose. And people were surprised. They're like, well, wait a minute. I thought I was doing a loan modification. And they're like, yeah, well, you're out of time and you're this far behind and you were denied for the loan mod. So there's some of those scenarios that can come into play. So what we want to do is offer you the opportunity to take a look at your situation by itself, look at your loan product, look at your scenarios, your job, your income, and be able to create a custom solution for you that moves you forward. One, they're designed to create temporary relief so what we want to do is to tell you